Hi friends, welcome to our Tax TV channel. How is computation of tax for selling a house?
As per the provisions of the Income Tax (IT) Act 1961, if the actual sale consideration is lower than the stamp duty value by more than 10%, the stamp duty value would be regarded as the deemed sale consideration for the purpose of calculating such LTCG.
I bought a house in 1998 at a price of 12 lakh rupees. If I were to sell this house today for 1.5 crore rupees, do I need to pay any taxes? I'm a retired person with no regular annual income. I get some income only when I rent out the property. Do I need to invest in another property or can I keep the entire amount without any tax liability?
Based on the available facts, it is assumed that you are a senior citizen. You bought a residential house property in India in 1998, which you plan to sell now. As the property has been held for more than 2 years, the same would qualify as a long-term capital asset (LTCA), and any income loss arising from the sale of such LTCA shall be calculated as follows: sales consideration less expenses on the transfer of property equal to net sales consideration, less cost or indexed cost of acquisition, less cost or indexed cost of improvement, equal to long-term capital gain or loss (LTCGL). 1. As per the provisions of the Income Tax (IT) Act 1961, if the actual sale consideration is lower than the stamp duty value by more than 10%, the stamp duty value would be regarded as the deemed sale consideration for the purpose of calculating such LTCGL. 2. As per the provisions of the IT Act 1961, where the LTCA becomes the property of the taxpayer before the 1st of April 2001, the cost of acquisition (COA) shall be the actual cost of the property or fair market value (FMV) as on the 1st of April 2001, not exceeding stamp duty value of the property. Since the property is an LTCA, you are eligible for the benefit of adjusting the COA based on the applicable cost inflation index (CII). Further, the cost shall be increased for any expenses incurred for the improvement of the asset, assumed to be nil in the instant case. Indexed COA would be calculated by applying the following formula. Indexed COA equals COA multiplied by CII for the financial year in which asset is sold, divided by CII for the year in which property was first held, or financial year 2001 or 2, whichever is later. It is to be noted that LTCG income would be taxable as per the provisions of Section 112 of the Act, it est at 20% plus applicable surcharge and education cess. Assuming you are a resident in India and your other incomes are below 3 lakh rupees, i.e. the maximum exemption limits for senior citizens up to 80 years, the benefit of the unexhausted exemption limit shall be allowed against the LTCG and the balance gain shall be subject to tax. Further, you may claim the following deductions from LTCG income and thereby reduce the tax outgo, if any, subject to the prescribed conditions and timelines, under Section 54 of the Act, by investing the LTCG in another residential house in India, under Section 54 AC of the Act, by investing the LTCG in specified notified bonds, and under Section 54 GB of the Act, by investing net consideration in equity shares of an eligible startup.
Please visit our website www.onlinetaxspecialist.com. Please like, subscribe and share our Tax TV channel and comment.